let's start off with something different, okay? First, let's take a deep breath and relax. We've taken a hit. I know it's your money. You probably had bullish positions. You might have had some bearish position. But in the last week, the volatility, last 10 days really, as it says on the front cover of the Hitchhiker's Guide to the Galaxy, and of course Starman's Tesla display, don't panic. All right, the Roadster now heading out into the universe, nice soft, don't panic. Okay, let's clear our heads, talk about where we are, things that one could have possibly done, and things that possibly can be done now, and then get to your questions. I have a couple already come in, it looks like, from Derek. We'll get to that in just a moment. We're going to spend 15 to 20 slides here just talking about some things where we are now. All right. So where are we right now? You're looking at essentially a 1-month chart of SPY. Sort of got pixelated there when I copied it over. The other images, I promise you, look better than this. But this is SPY 1 month. And you see here at the peak at about 286 there. And of course, where we are today. And we did recover at the end. Now this was done at approximately 2:45, 3 o'clock this afternoon. So there's a little recovery at the end there, which is pretty good. When we see here what's happened in the last 10 to 12 days or so and what's been happening in the last month. So where are we right now? Are we in a correction? Well, I think so. That is personally. We've seen a move of 33-point drop on SPY, about 11.5% negative in 9 days. Dow's down roughly 3,200 or about 12% in those last 10 days, 9 days or so as well. Hold on, let me see, okay? All right, so that's kind of where we are now. Now, this link didn't copy over. I apologize for that. I normally don't use CNBC as a trading resource, but I came across this article today and I thought it was interesting. It was posted yesterday. Stock market is officially in a correction. And I just thought the notes that they had, some of the bullet points they had here were interesting. The average bull market correction is 13% over a 4-month period, and it usually takes 4 months to recover. That's a quote from Goldman Sachs strategist Peter Oppenheimer, January 29th. But, you know, he says the pain usually lasts for 22 months on average if the S&P falls at least 20% from its record high. All right, when we just saw that we were down about 11 or 12% or so SPY from its recent high. Well, I'm saying that if it crosses down to 229.80 for SPY into the bear market territory, the average decline is 30% if it's a bear market. So the discussion is now, are we in the smaller correction or are we heading into a bear market for the bigger correction? And what can we do, of course, in either situation? Okay, last week of stock market drops, they feel is taking the S&P into correction territory for the first time in 2 years. So yes, a correction by definition. I'm not necessarily going to say it's a bear market, but again, that's what we can look at on these positions, okay? I'm scrolling through quick. I've got about 5 questions from Arvine and some others. I'm going to get to those in just a moment, okay? Now, this I thought was pretty interesting. This is a look back. This was their chart from the CNBC article, some past corrections, looking at decline amounts percentage-wise versus duration and the time it took to recovery, okay? So now it goes back, this actually went back into the 40s. I just grabbed from the 80s here. But from February to March of 80, it was a 17% decline, okay? And it only lasted 1 month for a 17% decline, and the recovery to get back took 4 months. Now that 2-year time period, November 80 to August 82, 20 months of a bear market that dropped 27%, that 30% they talk about. But the recovery after the 20-month decline took 3 months to get back. Something changed economically, obviously. Okay, and you see here, there's that other one, the 32% decline, 87. It only lasted 2 months, but it took 19 months after that to get back to recovery. Now here's some of the ones we might look at right now as a consideration. Okay, October 97, 11% decline, happened in 1 month. We're down 11% in 9 days. It took about 1 month to recover. Makes about sense. 3 times the amount of time is what some investors use as a gauge. Going forward, of course, let's talk about what we know. The 57% SPX, SPY decline, broad market decline from '07 to '09. 17 months, took 49 months to get back. But you look at the recent 12 and 13% corrections from August 15, from February 2016. Remember that first couple of months in February 16, we just saw it go down. It started in November. I remember I was at my in-laws' house for Thanksgiving dinner, and that's when that oil trick happened in November 2015. The oil went down, and then I came back to work going in December 1st. I'm like, I wonder if that's a signal of something else. Well, it took that 3-month time period to decline, but then it was 4 months to get back. So now, I'll be honest, I don't have the answer to this question. Are we in just this 12, 11, 13% corrections that we've seen before? Well, it seems like we are. It didn't take 3 months to get there. It only took the 1 month. Or in this case here, whatever happened back in 1980, okay? But here it took 1 month to recover. Here it took 4. This took 11. And the last one took 4 from 2016. So that's just, and it was, volatile in between, as we've seen with volatility now. You'd have days where it'd go up 200, and then the Dow would be down 300. Then it would go up 150, up 40, and then down 200. So there were big swings when that was going on, okay? And yeah, I'll get to that just at a moment. Okay, so this is just an interesting chart that gives some decent, I thought it was useful information and kind of interesting to eyeball. But what we don't know is that, are we done now at this 13, 11.5, 12% decline? Or are we heading more towards the 30, 35, or 40% decline range? Okay. Sam's thoughts is that he still feels selling is going to occur. Okay, that the market's still oversold. Now, what is the cause? I don't think there's any one cause personally. I think there's several causes that are occurring this. We did have some profit taking. I had a call with a coaching session with a gentleman yesterday, a PowerOptions subscriber, and I told him that I see this, some people call it the January effect. But a lot of people, when they do their taxes, what they end up doing is they also reorganize their money into different ventures into different places after 1 year. And we've had a very strong year, as Sam just mentioned. He still feels there's going to be more profit taking, if there hasn't been already, or more fear. And people will be pulling money out, maybe going into different directions. That whole volatility hullabaloo had a big thing to do with what we've seen in the past few days as well. For some of us, it worked out extraordinarily well, and we're going to take a look at that in a moment. But a lot of bets were placed on volatility not moving because it really hasn't moved significantly in 2 years, 2.5 years, with a couple of glitches here and there. So a lot of bets on those volatility indexes and ETFs, people doing iron condors on the volatility indexes, butterflies maybe, short strangles, for example, and boom. Once that started to trigger, that started buying and closing and adjusting had to happen quickly, and that was pushing things up. You probably saw that Credit Suisse is getting out, actually, of the volatility. And the volatility, some of the ETFs, the 2 times and 3 times volatility ETFs were halted trading back a few days ago. Okay, CBOE has even talked about reducing some of their more risky 2 times and 3 times volatility indexes on their listings as well, for fear that it's something that investors shouldn't be trading. Well, it's something investors shouldn't be trying to make a profit off of, in my opinion. Sam, I know you do really well with UVXY and different things, but you're safe. But it shouldn't be looked at as something that's a strong way to make hundreds and hundreds of percents or things of that nature, even though you can. It's more designed to maybe help you hedge a portfolio. Bond yield and the interest rates. Okay, interest rates are going to go up. I've been saying that they're going to increase the interest rates. That's causing some money to be pulled out, money to be readjusted. The bond yield, of course, is increasing. That's one of the reasons. They're more attractive now. Okay. Maybe it was in addition to all of that. It was just time for the market to take a breath. Correction was coming. Okay, and we had mentioned that. And we've talked about that on several webinars here on Friday and more, but it was also coming. Is there also perhaps fear of budget overspending? New budget has been passed. New concerns have been coming out there. I'm not trying to get political and take one side or the other, but I'm saying there's a lot of money that seems to be flowing around, and a lot of people being indifferent on both sides of the aisle to the deficit as a whole. And maybe that's concerning with other things that are going on about how exactly does that want to go in. Anyone can chime in if they have any other ideas about this as well. But these are the general things we've been talking about, okay? These are the general ideas that have all led to this. One thing might be more important than another, but in general, it all has to do with it. That whole volatility switch, this just made it more pronounced, okay? That volatility spike and people having to cover positions when it started to go, that just made this more pronounced. But then again, the fall in the broad-based indicators, the broad-based markets, they were overextended, okay? It was time to do that. Now, what could have been done? Now, we have blogs for you. We have white papers on using stock or portfolio insurance. Insuring positions directly, I've got about 4 or 5 questions that have already come in about protective puts. We'll get to those in a moment, but also ways to insure your portfolio without protecting the stock directly. That's usually the best way. Might not be the best, most economical way, but that's usually the best protection you can get. So you can always go to blog.powerop.com. We've taught the ideas of limited risk trading at radioactivetrading.com. I've got questions coming in about that. And always, whether you're doing spreads, diagonal spreads, you're trying to use leverage, or just buying calls or buying puts, proper position sizing is extremely important. We're going to take a look at that in just a moment as well, okay? Anything you're trading should not represent too much of your portfolio. In leverage spreads, bear call credits, bull put credits, where you can easily take 100% loss. In a situation like this, I'm going to show you 3 trades I placed that I place every Monday for a 2-week bull put credit spread trade that's had a 94% success rate over the last 3 years, but only had a 30% success rate over this 2-week cycle that expired today. All right? But that's what can happen, and you can lose 100% on those spreads, so it shouldn't represent more than a certain single-digit amount of your portfolio for each spread position. Okay? So what could have been done? Well, we have some references that we'll point you to, all right, in that view, and we'll look at that also, okay? All right. Now, were there signs? Yes. I mean, you had articles coming out, fear when the Bitcoin, and everyone started talking about the fear of the Bitcoin and how it's going to hurt investors. That should have been a trigger to us all that something's going down. But the market sentiment tool is something that Ernie developed. He has 13 broad-based indicators that we use in the market sentiment tool. And we've set fences on those indicators. And Ernie tested this over a long period of time. What essentially it is looking at things such as stock highs to stock lows, new stock highs to new stock lows, percentage of stock gainers to losers, number of days SPX has been above its 20-day moving average or its 30-day moving average, for example, and things of that nature. We'll take a look at those later. And then we set fences on when it gets to this range, that usually is a bearish signal for that particular indicator, or it's a bullish signal. Now, it led up to bearish sells for extended period, and then on 129, the very bearish sell warning. Okay? When I see that on power options, my action is I'm going to adjust my married put positions. If I have gains, and you can see it here, the market, was still moving up. 28.39, 28.39, it's holding. It goes up to 28.72, then to 28.53, and that's when it was triggered. 10 bearish out of the 13, 3 neutral, and no bullish. Okay? Again, so married puts. If I'm in the married put, the protective put position, and it has a gain and it's at or near my put strike price, I'm considering rolling that put up to lock in some of those gains, or maybe adding an additional put. Some of you who follow the fusion trades, you know what you're going to see in a couple moments there. Also, it might be a good time to sell a call against a stock that you own, a bearish, a married put position or a collar. Sell the call at that point. If the market falls, you're going to keep most of that premium. You've already got the hedge in place. I'm in bull put credit spreads. When I saw the very bearish sell trigger, I thought about closing my short puts if they were profitable, or adding an extra put to create a ratio put spread to follow the new pattern that was going to be a warning. And in my long calls, I either bought puts against those or closed them out for a profit. Maybe rolled them up, but that's something we'll show next week as well. Okay? And wanted to consider adding insurance overall to your portfolio, whether you want to buy puts on SPY, QQQ, NDX, for example, DJX, things of that nature. Calls on the VIX, another way to insure your portfolio, UVXY, as Sam mentions. Okay? Plus, once you start seeing all the articles where people saying, oh, there's a concern of a market decline, then you have people coming out and say, no, no, you're going to miss the boat if you get out now. Everything's still good. Yes, we're extended, but this new high is only the new high till the next new high is hit. The minute I start seeing more conflicting ideas in general articles and general news sources, that's when I figure that no one knows what they're talking about. It's a 50-50 shot, so I might as well add protection and put some of my positions in a better place if the market falls, all right? Now, would any of it worked? And Sam, I wrote this before you sent your email, but if you've joined us before, you've heard Sam join us almost every Friday talk about his positions on UVXY as a market hedge, whether he's doing them as a spread position, it's a volatility ETF, but whether he's doing them as a spread position or a straight call or straight put, he's kind of following the trend of buying low and selling high, but using calls and puts and spread positions on UVXY. I've used VIX and VXX as a portfolio hedge, and most of it is less than 2% of my total portfolio value. Okay, and Fernando, I'm going to get to your question in just a moment. You just chimed in, and we're going to see something. You think it's a good idea to sell a put on the VIX? Not right now, I don't, but we'll show you why in a moment. Okay, so following January 18th expiration, going into the next monthly cycle, January 22nd, Monday following January expiration on the 19th, excuse me, VIX was at 1120, closed at around 1103 that day. I bought 10 February 14th, next week's expiration before the standard expiration, 14 strike calls, roughly 24-25% out of the money that were for 75 cents. Okay, so, oh shoot, I'm sorry, I kind of messed that up. I'm sorry, no, I'm good. So the total outlay was $750, which is under 2% of my portfolio for the 10 contracts at the 14 strike. Right? Now, why do I do this? Many of you know that 50 to 60% of my portfolio is in the radioactive trades. We're going to talk about those. Got a lot of questions coming in on those. So it's limited risk already. But 10 to 15% of my portfolio is in the bull put credit spreads, following the weekly bull put screen on PowerOptions that we've created and I've tested and talked about. And I still do diagonal calendar spreads, about 10 to 15% of my portfolio. And then some remaining ones are straddles for earnings, okay? You know, buying call, buying a put based on an earnings play short term. Now, this one here I also don't need to worry about because with the market decline, even the earnings straddles that weren't profitable when the earnings came out, let's say on Tuesday, by Wednesday or Thursday, they were profitable because the market was falling. So the put side took over and these were still profitable in those. I don't have to worry about these because it's already hedged. So that $750 in VIX calls is designed to protect the speculative portion of my portfolio in leverage spread trades, or if I was just buying calls, buying puts for speculation. Okay? Is it a good hedge? Well, this is an extreme example, but yes, absolutely it was. So what we have here is we bought those 10 calls on January 22nd. Normally, I would have sold here when those February 14 calls, is around January 2nd, were at 220. I'm sorry, February 2nd. I would have closed half here because they were at 220. Remember, I paid 75 cents, so have 100% gain. I usually would have closed half, but I kept them open. And then February 6th is when we had the jump. This must have been the 5th. I apologize. Okay, so we had that first jump on February 6th. Those 14 strike calls went to 1020, so I sold 5 of them. I sold half of my position at the first spike, so I've got 5 remaining. And then we went up the next day, and it sort of came down, so I sold another 2 here at 710 per contract and sold another 2 yesterday at 1140. I've got 1 call remaining that's roughly around 1450 of the 10 contracts I originally bought. And this is an extreme example. Why am I holding the 1? Well, just in case something catastrophic happens over the weekend. Might add to it. Really, I should with the profits I've taken on that. So we paid $750 out for the 10 calls. The first batch closed was $5,100 in at 1020 for 5 calls. $1,400 for the next 2 calls, sold at 7. $2,280 for the next 2 calls, sold at 1140. All right, so that's $87.80 in, paying $750. So it's an $8,030 profit with the VIX hedge. Okay, I still have the one call remaining, as I mentioned. Now, but did it hedge? Well, as I mentioned, the radioactive trading portion of my portfolio, and John wrote in a moment ago, and he says he's really glad he came across radioactive trading and bought the long-term puts on all his recent stock purchases before the last 10 days. Absolutely, I agree with that too. And so, but this case here, what we did, those of you that are in Fusion, and if you followed the Sony position 12, 15 days ago before the earnings, we converted it into sort of a long stock straddle. We own 2 puts and 100 shares of stock. So the earnings came out and the stock went up, and this looked like a failure. But we're 8.2% down, owning 100 shares of stock, and right now we're at a small profit, and if it keeps continuing going down, we're going to be successful there as well. Okay? So I'm not worried about this. What I'm worried about is this. Okay, you've heard me talk about how I usually try to allocate no more than 10 to 15% of my portfolio to leverage spread positions. Following what I do and what I've talked about with the bull put credit spread weekly positions, on January 29th, I did open 3 bull put credit spreads. Netflix, 26,250 to 260 put for today's expiration was a 37-cent net credit. Did 6 contracts, was a $1,500 risk. I don't know where Netflix ended up closing. I do apologize, but right around 3 o'clock when I put the last touches together here, we see that Netflix was at 250.10. What does that mean? Full loss on the Netflix bull put credit spread. Red Hat, 121 to 119. 2-point spread, 25-cent net credit, 6 contracts, 1,200 risk. Red Hat is actually at around 124. Okay, 124, 125. So this one's profitable. But 6 contracts times 25. You know, so you can see we're getting $150 there. URI 33, 5 contracts. It's a 170 to 167.50 bull put, 1250 risk. URI is at 161.60. Okay, so let's take a look very quickly at the portfolio and power options and see where we are. It's going to be a subtly different view, I know, so let's go ahead there and get ready to adjust our eyes. Here's my 3 bull puts that went out today. As you can see, of course, the Netflix position, well, that took full loss. Okay, it's roughly 1278. You know, it was a 1,500, but with the credit received, 1278 full loss on the Netflix. 1085 on URI. Full profit here. And here's my diagonal calendar spread. Back on January 22nd, I only did 1 contract of a calendar spread on Amazon. Bought the April 1300 $88.50 per contract, $8,850, and sold the 1340 call for February 9th at $7.50. Well, that expired. It's at $13.39. Okay, so this by $13.40, I'm sorry, did expire there. But what's interesting is that the stock had dropped before it recovered. I mean, the stock itself had dropped, but my call has moved up from 88.50 to 110.50. The reason for that is something else, something that helped us here. But this should actually be, I'll explain why in a moment, this should actually be at $66. So I should have another $2,000 loss on this calendar spread, in addition to the $1,000 loss on the URI trade and the $1,200 loss on Netflix. Okay. Now, why do I say that? Well, of course, what ended up happening is with these positions, the 1,278 Netflix represents about 3% of my portfolio. So number one is position sizing. Regardless if you're trading leveraged spread trades and you have insurance, it should only represent a small portion of your portfolio. The 1085 loss on URI is 2.7. And I mentioned the gain on the calendar spread, which was kind of dumb luck. You know, the stock dropped from 1327. It was down to 1315. We saw it came back up. But over the last 5 days, what happened even to that April call is the implied volatility moved from 0.26 to 0.44. If volatility, implied volatility remained the same, well, naturally we wouldn't be in the position we're in the market, but that 1,300 April call that I paid $88.50 for would only be worth $69, about another $1,700, $1,800 loss on that call, even keeping the $750 from the call that expired today. So you can see here that this portfolio, The speculative portion of my portfolio took care of itself, but I should have been down 1,900 here, the 1,085 I lost on URI, 1,200 on Netflix. So again, we would have been down about 3,500 or so. Why am I going through this all in detail? Well, I still follow the bull put credit spreads I talk about. It was only right 33% of the time this month. But think about it this way. Is the VIX considered a good hedge? I bought a 20... There we go. So I had bought a 20% out of the money put last month on the 22nd for today's expiration. I'm sorry, next week's February 14th expiration. My apologies. It's a standard expiration, but they expire on Wednesday, so I go to the expiration, okay? If I had done that, and that was based on a hunch. That was based on the indicators that I saw, the sell warnings, even before the very bearish sell. I wanted to hedge my portfolio, so I used the VIX calls, okay? Now, if I had done that over the last 6 months, so starting on August 21st, when VIX was roughly around 13, 15, I might have bought the September 13th 16 call, and again, put about $700 into the trade to represent, 2% of the total portfolio for protection in case of worst case scenario. What would have happened each month? Lost $700 in September. They went to zero. No point here did it ever get to a place where I would have sold it for a gain. Okay, you'd think it was here, but it wasn't that much of a gain. It was maybe 5%, 10%. So it wasn't enough to consider a trigger to close, because you think, oh, well, if it keeps going up, then yeah, I can have more. And then from this spike to this spike, didn't even get me. So we would have lost the 700. Same thing from September to October. October after a standard expiration, buying for the Wednesday before the next expiration, and so forth. So 5 months of losing 3,500. If the implied volatility hadn't kicked in on my diagonal spread, that side of my portfolio would be down about 3,500 as well. And we made $8,000 on the VIX protection. So it does work as a hedge, but it's not like this $8,000 really jumped my portfolio. And think if you'd been doing this for a 12-month period, where the VIX has been in the last 12 months. Some of these months you would have gotten out with maybe a small profit or not a loss, 10%, 20% profit. But in general, allocating 2% per month to insurance, we would have run the risk of taking down close to 24% of our portfolio, which means to stay ahead, our total profits would have needed to be 45, 50% on the remaining portion of our portfolio. That's what's dangerous about the month-by-month insurance policy using SPY puts to insure a whole portfolio, VIX calls even, is that a lot of times you're going to lose the money you put aside. And if you never get the trigger in the downturn, you're never going to get back to square one. But this was a great hedge to do. This was a timing play based on the market sentiment tool, and it worked out in the end, okay? But what to do now? I'm going to get to your questions in a moment. And some of you had mentioned things here. Fernando had said, is it time to sell puts on the VIX? I don't think so, okay? I'm going to hold off for a moment, because if the market starts to go back up, the VIX is going to fall. The VIX puts are really expensive right now. And if I'm thinking the VIX is going to fall, I might want to buy puts. But they are really, really expensive. I can go 40% out of the money, 50% out of the money on the VIX and be paying almost $4 per contract. Remember when I was 20% out of the money? And for next month, right now, 20% out of the money, 40 calls are around 75 cents, sort of what I've been paying. But are we expecting the VIX to spike up more and go to 40, go to 50, go to 60? It's below, I think, 30 again right now after the jump in the market towards the end of the day. So I don't know if it's time to buy VIX calls right now unless you think there's going to be another trigger that's going to cause it to spike. I'm not sure if we're going to see the type of spike we just saw again. What about buying puts on the VIX? Ernie's thoughts were if we see the VIX go above 50, then yeah, it might be time to buy it, but they are extremely expensive. Better idea if we think the VIX is going to fall is maybe do a bear call credit spread or a bear put debit spread in that case, okay? Yeah, and Sam says in his UVXY positions, the options and volatility is usually paying up to $5 to $8 per trade, okay? Another reason, Fernando, why I'm not comfortable right now considering selling a put on the VIX, a cash secured naked put on the VIX, is that yesterday, market sentiment trigger went the other way. Valve sort of opened up and released. That bearish pressure on the indicators, you can see some of them there, the put-call volume ratio, SPX number of days up, SPX gap over the SMA 20, new stock 52-week highs. Well, this release caused all the pressure to move off the bearish levels and start to go into the bullish. We've had a light buy for the past 3 days, and then the bullish buy was triggered. Now, I'm not saying that this means that in 5 days from now, SPX is going to be back up to 2,800, 2,750 or anything like that. What I'm saying is that I'm hesitant now based on this indicator. I use this to adjust my trades, place trades, and more. But based on what I'm seeing right here, I'm holding off on Monday to do anything more extravagant. We have to anyway because the market's closed. But I'm holding off because the bullish buy has been triggered. I'm not sure if I want to buy calls on the VIX right now, because if it does start to move back up, the VIX is going to drop. Not sure if I want to buy puts on SPY right now, because if it starts to move back up, I'm going to lose money. An out-of-the-money bull call debit spread. I'm sorry, in-the-money bull call debit spread with a good probability. Or maybe an out-of-the-money bull put credit spread on one of the broad-based indexes might be a good idea now. But with the idea knowing we're going to manage it. But I wouldn't sell a naked put on the VIX even though it has high premium, because this is telling me that things have eased off. It might stagnate and move back up slowly for a little bit, in which case the VIX is going to settle quickly. Okay, it could settle very quickly. It could be back down to $15, $16 ranges in 5-10 days. It could also be up to 50. Okay, that's the nature of the volatility. So not a fan of selling into it like that on naked puts or credit spreads. But again, since the puts are so expensive, if I think the VIX is going to fall, I may consider a bear call credit spread or a bear put debit spread on the VIX also. Okay. As I mentioned, this means start buying. It means that the bearish indicators have eased. But now we have to ask, from what we saw in that previous discussion, are we in the 12% correction range, or are we going into 30% of a bearish market? The time will tell, but I think next week, based on the market sentiment, if it doesn't happen on Monday, maybe or Tuesday or Wednesday, you'll see some of these stocks start to move back up. You'll see some swings upward, as we saw at the end of the day today. But that doesn't mean 2 weeks from now we're still going to be up. Okay? How long would they go up? So what is the play moving forward? And we're going to get to the questions now because this relates to it. What to do now is to protect your positions in your portfolio. Protect the stocks with long-term puts, okay? Stocks that you're in, stocks you have a gain on, maybe stock you cut down and average down the cost, sold at half of it at some of the highs, but you're still holding it. Protect the rest of it with long-term puts. You're not throwing money away in insurance with the radioactive trading techniques. It's actually a second asset that works in your favor to manipulate. I know we're going to look at that with at least 3 or 4 questions I saw come in. You can also do that with calls. You're going to see a video blog next week on managing long calls. I know it's probably past the point, but it's always good material to have and something one of my customers asked me for. Okay? Your portfolio as a whole, the speculative portion of your portfolio, consider, yes, buying puts on SPY longer term, or maybe VIX calls. But wait to see what the market does now. If we start to move up next week and things start to ease off, we see the VIX drop down to the 20, 18, 16 level, maybe that's time to buy some calls, but don't use more than 1.5 or 2% of your portfolio as a hedge. Same with the puts on SPY. Yes, you want to hedge your position, but you don't want to waste all the money putting 15 or 20% of your portfolio into portfolio insurance, okay? Because that will not only take away the gains if the market does recover, it also means that month by month, you might be taking too much of your portfolio out. Position sizing also applies to using broad-based indicators to insure a portfolio, all right? And of course, we talked about the bear spreads. And evaluate your position size. With this last decline that happened over the last 9 days, was there 1 or 2 positions in your portfolio that brought it down the most, whether they were long stocks, whether they were long calls, diagonal spreads that maybe you entered too many contracts, you felt really good about that stock, maybe you've been trading it for months on end. Evaluate your position size. The ones that hurt the most, maybe restructure them, do some of the repairs we're probably going to talk about in just a moment, or stock repair, option repair positions on them, but then maybe restructure the size. Cut it down so if there is another spike, there is another sudden shift, that one doesn't hurt you as much. We'll point these out later, but we always end up mentioning these. You know, the need to fix, if you need to fix broken stocks, go to the webinars page. It's a full webinar there on managing your broken stock positions. Or if you got assigned on a naked put where the stock fell too far, there are ways to manage that now. You don't have to just sell and take the loss, depending on your outlook. Okay. Also, we can use the stock repair tool. We've talked about that in a couple weeks. If you've got spread positions that are in trouble, on the webinars page, check out the one under the option strategies column for managing spread positions. And if you think we're in a bearish market, if you think we're going more toward that 30% bearish market range, that we are in a correction, but if you think we're going more to bearish, but you still want bullish income, you know, you still like to do covered calls, naked puts, and bull put credit spreads, consider the inverse ETFs, a covered call on SH, naked puts maybe on one of the 2 times SPY or QQQ ETFs, the inverse, which will go up in price if the market continues to fall. And if the market stagnates, these will stagnate too. Okay? So it's just another idea of not only a hedge, but continuing the type of strategies you're doing with securities that will be moving up neutral to bullish if the market becomes neutral to bearish. Okay? I'll have info on that for you next week as well. All right. So that was kind of the wrap-up I wanted to go through real quickly in the sense of where are we now in my opinion? What are things that could have been done in your account? And what can you do going forward? What are some of the tools that you can use, such as the market sentiment tool, the ideas of protection, and more going forward in the market? Okay, so that's just what I want. Where are we now? What could we have done and what we can do going forward? Most importantly, of course, remember, don't panic. We've got the tools. We've got the education to help you. Sam threw out 4 quotes here, 4 links here. SQQ, TAZ, FAZ is one of his favorites. Those are some of those inverse ones that he likes to use. And mentions EVAN as well, even 10 and 8, I think he's going to say. All right. So all that being said, let's get back to the top. There's a lot of questions here. I do apologize. We're going to go one at a time. And I'm going to navigate over to the PowerOptions suite of tools and go right to the main menu here. And let's take these questions as they came in. The first one is from Derek. He had a protective put on SPY and QQQ before the meltdown. Closed out both positions for a loss. The price was below the put price. What would have been the best method to exit this trade? Okay, well, it all depends on what your future outlook was, Derek. What your strategy was going forward, and how long of a time frame you had left on your puts. Okay, let's go to the chain for SPY, and we know that it was 8-9 days ago. So I'm just going to cherry pick. I'm going to go to a date. Let's go back to January. You know what? We'll just go the day after January expiration, January 22nd, when I bought those calls on the VIX. And SPY, we see today's at 261. So SPY was at 282.69. Now, I'm sorry, let me jot this down. 122, 282.69. If I was opening a standard buried put, Derek, the way that I do it, following the radioactive trading techniques, I probably would have gone out to June and maybe further, but they're August. All right, I'll go to July. I'm sorry, I'll go to July. This is how I would have opened it on January 22nd. I would have gone to July at least 150 days out. Put I would have purchased, let's just go to the puts only. Okay. Would have gone a couple strikes in the money here. 282, yeah, I'm going with the 285, keep it simple. 968 to 983, let's just say I got in at 975. 7 cents up, 8 cents down, midpoint price. Okay, so we'll put that in at 975. So that would have been my position. Okay, let's just enter it into the portfolio, shall we? We'll go to a new portfolio here. And I'm going to leave this one alone. Oh yeah, go to DIA married put. That's a good one to look at too. Is that married put still in there? Yes, it is. We'll talk about that existing one as well, but it's only down 2.7%. The position on DIA we did back on January 11th. Let's enter your potentially what we would have looked at on your position, Steve, or Derek, I'm sorry. SPY, 22nd, 100 shares, 286, oh, sorry, 282.69, my apologies. And then I would have bought the July 20th. $285 put. All right. And I said the price there would have been $9.75. Roughly. All right. So SPY, it's down 7.5%. Not too bad. 261.50. Okay, so it's like a $28 stock moving to a $26 stock. Sure, it's 10 times as much. You're losing $2,100, but you've gained $1,600 on the put. All right, let's just go to the profit and loss chart. Now, the max risk we know is only 2.5%. That's the worst case scenario, if I only get 285 back. If I've decided that I want to get out of this position, I don't think it's going to recover anytime soon, or maybe I want to wait till things hit a bottom and get back in, possibility, then you probably did the right thing. You would sell to close your July 285 put and sell to close the stock. Now, you would not have taken this 2.5% risk. As we can see here, the max risk on this position for SPY, the max loss is 516. The liquidation value, 1.8%. Okay, so even though you only had a risk of about 2.5%, you're only taking 1.8% if you liquidate right now. Another option talked about in the blueprint, even if the stock goes down, let's take a look where we're at. We know we paid $9.75 for that July put. The 285 put, I could sell right now, $24.99 to $26.58. So let's call it $25.75. Okay, so let's go ahead and sell it now at $25.75, midpoint-ish. So now what I'm left with, a long stock with a cost basis of $26.69, $266.69 is trading at $26.150. That's only a 5.5 point drop. So what are my options now? I could buy a cheaper, closer input. Let's say let's go to April. Let's cut our time in half. And maybe even at a lower strike. Not going to be the best. Let's go to the 265 for only 1038. Well, 1040, 1050. So I've gained $16 on the put. I'm going to take 10 of that to buy another put that's roughly 20 points down. This is going to increase my risk, but only to 4.4%. And I've got a 265 put now on a stock trading at 261. I can continue to manage this using different income methods. Another idea is that instead of, a lot of times if you just own stock or you had a covered call, you consider averaging down. You know, you buy more shares of stock. I've averaged down my cost here just by doing this, just by selling to close the put. I've averaged my cost down by roughly $16. I'm sorry, yeah, by $16 without buying new stock. Now what you might be able to do with this newer cost basis is I might be able to go to the stock repair tool. So let's try that. Let's go to SPY. After I've sold to close the put, I'm just holding the stock. Sure, the market could still continue down. If I go to SPY and I go to stock repair, we're going to use our new cost of $266.70. Let's just keep it kind of even. $266.70. We'll just say 100 shares there. Okay. I'll go yell at the programmers later. Have 100 shares at $266.70 on SPY. All right. Well, I apologize for that. But the stock repair tool would try to build a ratio call spread for me to help me get back to break even faster. The ratio call spread wouldn't count as any naked options. It essentially counts as a bull call debit spread plus a covered call on your remaining shares. With a stock at 261, your new cost basis of 266, you might be able to do a March or even a February ratio repair using the stock repair tool that could get you back to break even faster, maybe even only needing the stock to go to 264 or 265. But with these kind of conditions, maybe I'm not interested in extending the risk, as you saw, increasing the risk up to 4.4%, which would happen if I rolled into the April put as we showed. But you would still lower your cost basis by 10 points. You'd still have protection and a max risk of 4%. If the market recovers, you may be able to make another adjustment to bulletproof that position. Okay. DIA position is actually a January 18 put. Now this is one of those interesting ones where we entered them. This was someone's trade. They entered at different days. It's actually a bulletproof trade or close to it because they bought the stock at 248. Then when the DIA went up to the 260, 265 range, then they bought the 270 put for 22. So I think this is a bulletproof position, but there's still ways to adjust it even though this is back down to 242. I could sell the January and buy a July, take in the profit here about 10 points, buy maybe a 245 or 250 put for July and pay maybe only $6 or $7. Okay, that's a possibility there. All right, next question came in from David, still related to the radioactive trades. David says he only does radioactive trading. He says, do you want the short call in the income method number 6 to be at or above? Do you always want the short call to be at or above the protective put? Always. Anytime you're doing any income method that sells a call, that involves selling a call, whether it's 1, just selling a call against the married put to create a collar, 6, the bear call spread against the married put position, 8, the condor, even 5, the ratio call spread, 11, the butterfly, any of those combinations that include selling a call, you want the call to be at or above the put strike price. Okay, let me show you why. Let me go to AMAT. Oh, not AMAT. Perfect, AMAT. This is not the married put I'm in. This is a different sort of position. But it's a married put position that's fallen drastically. We got in at 53.15, have the 55 put for 735. Stock's at 48.08. Risk was originally 9.1% on the steep side. Now this has fallen. I say, okay, well, the stock's at 48. I think it's going to stay there or below. So I want to do your bear call spread, income method number 6. Well, I can't do it at 55 and 60 because there's no premium. Even if I go, let's say, 14 or 21 days out. 30 cents for the 55 and then 5 cents. So you'd only get 25 cents. But you'd say, look, I can get $1.31 for the 50. And if I do a 52.50 at 64 cents, I get 70 cents here. So why wouldn't I do that? Because the key is not to consider it's just about selling, not selling below where the put is. It's about your cost basis. Anytime you sell a call, even though, David, you have infinite upside profit potential with this adjustment. See, if I just sold the call, that would be disastrous. My cost basis is 60.50. Selling a 50 call is going to put my risk, it's going to double it. My risk is going to go up to 10 points to the upside in the direction I thought the stock was going to go. Even if I add the second call, the bear call spread, which leaves the upside open, I have still agreed to give up my shares of stock at 50. My cost basis is 59.80, so my risk kind of dropped a little bit from the net credit here. But again, you see kind of the risk here. If it moves up, sure, you still have unlimited upside if it goes back to 60 or 62 or 65. But what are the chances of it there? The likelihood of where the stock's going to be trading is more in this area. And you've given yourself a little credit, a little bit of heartbeat, and then it dips back down. But again, that's why you don't want to sell it below. It always wants to be at or above. Now, you could get lucky. You could do this, and the stock could stay at 49. This would expire, and you'd have knocked 70 cents off of your risk. That's very true. Okay? But this is why you always want to sell it at or above, because you got to consider this, your total cost into the position, and anytime you're selling a call, it gives you an obligation to buy share stock. What if this goes to 52? What happens? Well, you took in a net credit of about 70 cents. The 52.5 would expire worthless. Now you got to pay $2 to cancel the obligation to deliver your shares of stock at 50. What does that mean? You just added $1.30 to that original 9% risk you had, so it's going the wrong direction. Okay, that's why we don't sell the calls below the put strike price. Whether it's a 6, whether it's just a 1, or whether it's part of one of the other ones. Okay, yeah, I got a lot of questions here. I'm just going to scan through. Okay, all right. Oh, and Sam, you did something I did with SMEs, just talking about he bought extra puts there, okay? Okay, and that DIA position was the one that John did. What I'm doing is I'm going back to the end to see comments here, okay? All right, Bruce chimed in and says, Radioactive Trading Works was able to roll his SKX radioactive collar from 6.7% risk to bulletproof to 9% profit, taking advantage of pre- and post-earnings volatility. Fantastic. Skechers was a good one. That looked really good. I'm glad you got there, is it, okay? But Mark asked, my question after a drop like we've had, which types of positions are you keeping and closing? Bulletproof positions? Yeah. I've showed earlier, I've still got my married puts in play. The SNE position is actually a straddle, which is profitable even though the stock's down 8% from where I got in. AMAT, I can still make it not this exact position, but I'm holding the 60 put, I believe, and the stock's at 48. I can still do an adjustment on AMAT that won't necessarily cancel the risk on it, but it might put me in a better position if there is a recovery. And if not, I didn't lose much more than I have. I should have closed the bull puts that I showed earlier. The 3 bull puts that I had and that calendar spread that I had for this expiration, I should have, where did I go? Sorry, looking for him here, Mark. I apologize. Bull put view? Nope. There we go. When I opened these on January 29th, later that day is when that bearish sell triggered. And I left these open because I had the VIX plays in place to hedge the losses. And as I mentioned, I lost a 2 out of 3. That's the first time that's happened doing the weekly bull put search in probably 14 months, maybe 15. But in any case, am I opening them tomorrow, Mark? No. Monday. Monday, Mark, is a hesitation day for me. As I mentioned, I saw the bearish bullish buy, and it's gone back to light buy because it readjusted today. So we've gone from the bullish buy to the light buy. I want to see what happens on Monday. And if Monday the market looks okay and the VIX drops, honestly, below 20, I might be opening bull put spreads again, adjusting that calendar call spread I have rather than closing it, which is very profitable right now because of the increase in volatility. And then we talked earlier about, as far as market hedge, I may consider doing bear call spreads on the VIX itself also, okay? Yeah, and the big question is there going to be a recovery? No, I'm not sure. I'm not sure. That's why I'm in a hesitation mode. I've got my positions open, managed some of them, used the VIX as a hedge to that to protect those other ones that I did take losses on today. I'm not going crazy with trying to buy calls or buy puts, speculating anything. I'm taking a breather. Just like I said at the beginning, let's take a breath and let's relax. I'm taking a breather personally. I've got that SNE position that's a synthetic straddle, radioactive trade. I'm going to keep that in play, and if it continues down, I'm going to adjust it. If it moves back up Monday, I'm probably going to adjust it also, okay? Sam does mention that the extra puts are a good way, so that if you have some capital gain on your position, you're considering buying 1 or 2 puts, or you already have 1 or 2 puts in place, you might want to consider buying a second one as well, okay? Yeah, and Martin had earlier mentioned, oh, I'm sorry, what are the symbols that Sam mentioned? He was mentioning TAZ, FAZ, I'm sorry, TZA. What was the other one? There was the SC. I think I deleted that one there as well. We don't want to kind of do it that way. No, but there was FAZ. I'll find that again. Okay. Oh, and Martin, you said one of the pundits was reporting several weeks ago. He says the put-call ratio is indicating we are ready for a downturn. Yeah, that's one of the ones we follow with the 13, including SPX stays up. This is the indicators for the market sentiment. Gap over the 20, 52-week high and low. The VIX, that went, to bullish. Let me show you why. What I was talking about with the fences is that this is the histogram of the distribution of single prices on the VIX, I think over the last 10, 12 years. Maybe not that much, maybe 7 to 8 years. I apologize. But you see here, it's a very infrequently does it reach above 33 or 34. So it's gone lightly bullish at 29 because infrequently does it stay above those lines. Okay. Same with put-call volume ratio. Okay, so right now we're just kind of in the middle, but where were we a few weeks ago? Okay, let's take a look. Let's go to the history there, Martin. On the very bearish sell, put-call volume ratio was in the bearish range. Absolutely. Our fence, it's bearish when the ratio is less than 0.7 and bullish when it's above 0.9. That seems like a tight fence, I understand, but this is the histogram of all the times the prices have been in there, and it's just a very small amount of time when they're above the 1, and a very small amount of time here when they're really below that 0.55, 0.57 range as well. But it was the bearish trigger. It was at 0.55, and you'll see it doesn't hit there very often. So that's, yeah, we would have agreed with that because that's one of the 13 indicators we're using in conjunction with one another. All right, back to the top. I apologize for that. I had to scroll through some of the bottom there and take a look there. Arvind asked, do we do ETF reports on your software? I don't know what exactly kind of data you're looking for in an ETF report, if you're looking for a full report of performance versus other. But in all of the searches, whether you're doing bullish, bearish, or neutral, you can choose in the lists function to screen just against, oh, I'm sorry, folks. There we go. To screen just against indexes and ETFs, just against inverse ETFs. If you think we're bearish, you want to do covered calls and bullish positions, you can do inverse ETFs, or you can choose to exclude things like the leveraged ETFs, the 2 or 3 times. Now, we don't do a full reporting on performance or stocks in that particular ETF or industry, I should say, but again, you can screen by them, okay, but we don't have a quote-unquote report RV, it's like an analysis. Stephen says, before this week's free fall, many of my positions kept going up. I had put, but I needed to constantly roll them. Is there any other strategy to use? Okay. Well, you don't always have to roll the put up if the stock moves up in price. Okay. You can, if you think the stock is still bullish, you can just leave it alone and do nothing. Maybe move it up once, cut your risk in half, and just let it continue to go. Because remember, as the stock continues to go up, Stephen, you're gaining more on the stock, and your put delta is getting lower and lower and lower and lower. Okay? It's good to do that to get the bulletproof status, absolutely. But again, I apologize, again, in that situation, if you're worried that you're putting in too much money to continually roll the put up and up and up, maybe let it grow a little bit. Maybe let it run and let that delta. Instead of using what we call income method number 4 to continually roll the position, just give it some time, okay, and let it move up in price. And if your stock is moving up gradually and you think you can stomach it, check out income method number 5. It's a great way to earn extra return in the blueprint there as the stock moves up on your positions, okay? Okay, so Sam was talking about that as well. Oh, okay, going backwards. Indrajit said, can we still do covered calls in this market? Well, yeah, the volatility helps with the premium, doesn't it? If you're worried about safety, Indrajit, I'd consider going more in the money. Okay, go deeper in the money if you're concerned about continued fall. The market's going to continue to fall, and we're going to go closer to that 30% bullish decline. Wow, 30% bearish decline, Indrajit. I apologize. From what we saw earlier, when we were talking about a 13 or 11% correction versus a 30% fall and was, quote, a bearish market. We're in a correction now, but are we in a bearish market? Not sure yet. We're hesitating. If you think the market's going to continue to fall, again, covered calls on those inverse ETFs might be a good way to go. You can go into covered call here. I'm just going to go into the basic search, and I'm going to leave everything as is, but I'm just going to go into the lists, and I'm going to screen just against inverse ETFs and see if anything comes up. Okay. Am I looking at another list there? Oh, I apologize. I excluded it. Let's see. If nothing comes up, I'll have to make 2 changes, and that's fine. Okay, so it's probably in the fundamentals here. Take out the stock price. Don't have to worry about earnings on the ETFs. That's another reason. Don't have to worry about broker rec. Yep. Above the 50-day moving average. I'm going to take out the MACD there. On options, downside, Yep. Yep, that looks okay. Oh, I don't necessarily have to go 10% of the money. 8's pretty good. Anyway, but I'll just screen against the inverse ETFs, and there you go. VIXY, DRV comes up, the real estate bear. That's a 3 times, though. Be wary of the 3 times ones. Pro short treasury, SRS is the real estate again. Natural gas bear one also. So these are more volatile because you're seeing 2 or 3 times. I might adjust this criteria to look for something more simple and actually exclude the leveraged ETFs, the 2 and 3 times, but still look at inverse ETFs. And again, if you're concerned, if you like the stock selection that you have, but you're concerned of a fall, maybe go deeper in the money, where you normally might go at the money or out of the money, projecting high returns, which would have worked well over the last 12 months or so. Sell deeper in the money, cover call. Okay, maybe buy a stock at 50, sell the 47.5 or the 45. Give yourself some protection, okay? Okay, Indrajit says that I would like to do the protective put covered calls and would appreciate if you can review it. Okay, well, we talked about that earlier. The married puts that I do, you know, this, the full discussion of, the full discussion of radioactive trade, the structure of what I do, and the 12 different income methods we use to adjust the position are all described in the blueprint there. The full work, the blueprint at radioactivetrading.com. You can pick it up here in PowerOptions or just go to the store at PowerOpt or at Radioactive Trading and check out the blueprint. It describes the full structure, all 12 income methods, when and how to use them. But in general, when I open a married put, I'm looking for a stock that I feel is neutral to bullish, and I have an expectation it's going to move up in price. I'm going at least 150 days out and in the money to keep my risk controlled to a 6 or 7% range at the most. Okay, earning might go up as high as 8, but that's what I'm looking for, is a structure that's in the money because that gives you the best return. The time frame also gives you the best return. The best cost basis per day. Not buying month by month, even though it looks cheaper, you'll end up paying more per year. Right? It's the opposite of selling. When you're buying for insurance, you want to be buying further out in time to pay the lower cost per day, and to give you the controlled risk, you want to go 1 or 2 strikes in the money. That's the basic structure. Webinars for you to check out, since we might not have the time to go through it all. Now, of course, the basics is once I set up the position, I'm going to wait. I'm not going to sell a call right away. Let's take Sky, well, where is it one? It's the one I was going to open the other day. Sky West, okay? It's not bad. It's at 53.50, buying a deep in the money 60 put for a 5.8% risk. Okay, so let's take a look at the profit and loss chart. Going back to what was asked, or what David asked earlier, so this is what I'm going to do, but I'm going to wait for the stock to move up. I would enter this position if I had the anticipation that this stock has the potential to maybe grow 12 or 15%, but also potentially, based on my judgment, I feel it has the likelihood of gaining 3 to 6% in the next 30 days and get up to 55 or 56. So what I don't want to do now is get into this position, say, okay, well, I've got a risk, of 295. Why don't I go ahead right now and get rid of half of that by selling the 55 call, actually for about $2 at midpoint. Let's say I get midpoint and I get $2. Okay? Remember, my risk was 4.7%. Now it's 9.8. Why? It's to the upside, in the direction I thought the stock was going to go, because I sold the call too soon and at too low of a strike price. And now from what David was saying, if I open this married put and I did that nice little adjustment at 50, it'd be about 70 cents. So I leave the upside open. Well, now I've got this sort of profit and loss chart where I could have a potential profit here at 55, but then it loses here. Remember, my target range is somewhere in here for the first 30 days. How does that help me selling the March calls in a structure where I'd be at a loss if it hit my target point? Just to get a little bit of premium here on the downside. It's not even that little. It's about $1.30, $1.20. It's a pretty decent hedge from the risk I started with. But let's keep in mind the bigger picture. If my target was the stock was going to be trading in this price 3 to 6% up, why do I want to enter a position where I'd be at a loss and be forced to manage this short call? Now I'm going to wait. I'm going to wait for the stock to meet that expectation, go up to maybe 55, 56, and then do a better adjustment that matches my goals. Or if it falls, I'm going to do something different. I don't want to lock myself in. Now, of course, if you sold the call and it fell, that'd look pretty good because you got the full $2 premium. But your expectation was it was going to be here, so why would you do this to begin with? You wait for the stock to go in your direction, then you make an adjustment. That's what's taught in the blueprint about the full radioactive trading techniques. Other things you might want to check out is go to the webinars page, powerop.com/webinars.asp. I'll set everyone in the chat window here, everyone in the chat link. All right. In the Power Options Tools section, I think there's one. Nope. Okay, good. So let's go to Option Strategies. And in the Option Strategies section, Power Options for Radioactive Trades from July 2015. Why is it such an old webinar? Because I've done this webinar since then, but I think this one is still the cleanest because I teach the same material essentially. How to do a radioactive trade, how to identify it doing the search tool, make adjustments based on your risk or tolerance, create your own stock list for searching, tips on technical indicators, tracking and managing the position, and more. Doesn't give you the wealth of information that's in the blueprint. It's just showing you how to use the tools, so that might be a starting point for you, okay? Indrajit, we had talked earlier about your position on NVIDIA. You had said that, you've got NVIDIA at 288 and you're considering entering insurance to it. I don't know if that's what you want to do unless you're concerned it's going to continue to drop. What you may want to consider is taking a look at the stock repair tool first. See if there's a repair available. Now, they're all out to, that's not bad, it's September, but there are some repairs there that are available right now. Wait for maybe NVIDIA to come back up to 232.08. Buying a put now, as we talked on the phone, will stop further losses to the downside, but you're already locking in the $50 that you have lost on the position, okay? If I go to the insurance tool, as we saw, it's going to tell you that your cost is too much. So I put an NVDA, you put in 288, you leave all expirations. The cost basis is too high. So what I would do is go to the custom spread tool here, and say, okay, well, based on what they were showing us, let me do NVIDIA. My cost basis is 288. I can't buy a 290 put now. It's way too expensive. The stock's at 232. So maybe I go out to September and I go a couple strikes in the money. Let me check out the 240 or maybe even the 250 put at 42 or $43. Okay? I might consider this. But again, the risk is $81 or 24.5%. This stops it from further losses, but it's not really helping you gain, and it's taking in more. Remember, your loss was only right now is $55. What's the extra $26 coming from? It's the time value on the put. See, if I buy NVIDIA today, that $26 is going to be my total risk. It's going to be incorporated into your risk as well at this time, but in addition to the $50, $55 you already have lost as well. Okay? Bruce had made a comment a little while ago about maybe it's market. It was a comment to the bullet point section I had about ideas for the market, and Bruce says maybe it's market makers shaking out the weak money to get bargain prices at bargain discounts at wholesale prices. Possibly, but it was driven by many other things. There might have been some shadiness going on in the background when it was available, but yeah, Sam mentioned he's had a great play on Snap in addition to everything that was going on. The Snap was a great one, a surprise to me. I was actually going to do a straddle on Snap, but I just didn't because I was in too many other positions at the time, and I just didn't think it would be successful. I've seen my daughter play, my 4-year-old daughter play with it. She loves all the little faces, the Snapchat faces and everything, and I'm just thinking, what are they doing for marketing? What are they doing for advertising? Well, clearly they know what they're doing for advertising better than I do. That was just a massive jump in the stock price. You said you had a 500% profit there on the Snap position, I believe, and that was a good earnings this cycle as well. Sam also mentioned SQQQ. I apologize, that was for Mark, I believe, who asked about it earlier. So SQQQ is the ultra-short QQQ ETF. Okay, so it was down 104 today because everything else recovered towards the end of the day. So that's the short QQQ. SVXY, that was the one I couldn't remember. I was trying to remember SVXY. That was the one you had mentioned that I forgot as one of the other symbols. FAZ, SQQQ, SVXY. It's the inverse VIX. Okay, so it's up to 128. Let's look at that chart. That's going to be a fun chart to look at, right? So there's your inverse VIX. Oh my, oh, there was a split in here. Was this the one that had that split in it too? I believe it was. All right. Okay. All right. So Hamat, I believe, is the next question coming in. All right. Let me go back here. Hamat says, you mentioned while selling a covered call, it should be more than the put strike price. Should it also be above the cost basis? No, Hamat, not necessarily based on your structure. Let me go back to SKY. SKW, SkyWest, I'm sorry. Let's go back to that profit and loss chart. Let me think about this for a minute. Let me illustrate. I think of how to illustrate this. You know what? Let's take an example, Hamat. Let's take a different example. I'm going to go back to the chain again. With our inverse ETF, what I probably should have done. But let's go to January 29th. All right. SH was at 28.32. And yeah, would have been forced to buy an August put 28.32, the 30 at 2.15. That sounds good. 30 at, well, okay, 30 at 2.25 for August. All right. Let's take a look at a custom spread here. I know SH is up, but I'm going to try to illustrate something here. Let's put in 100 at 28.32. And our August 30 put, let's see, now it's above, but that's okay. Buy one at 225. Okay. So when I originally opened this position, when it was trading at 28.32, my cost basis is 30.57. Okay, this one might not be as good an example for you. I apologize for that. So would I have to sell a 31 call? No. In the first month, let's go back to January. Oh, shoot, I went out of it. My apologies. Let's go back to just a few days ago. Let's go back to February 2nd. Let's see if we were up then. Yeah, 29.27. Okay, so let's say we waited. The stock went up to 29.27. Now, I know this is going to appear strange. I wouldn't have gone 14 days out. Let's go to March. This would have hurt, but wow, terrible. So maybe we sold the 30 at 35 cents. Okay, and the 31's at 15. I know this seems like splitting hairs. We'll do a different example maybe in just a moment. Okay, but when you're asking me, you know, is it better, let's say we did that a couple days in, and yes, I know we're up at 30.72, but let's say I sold the March 30. The graph will be what we want to see, right? I'm going to sell that at 35 cents. So the rules that apply, there are rules that apply, Hamat, to this position. Number one, when I sell a call, wow, this is really low risk. I got to get a different example. I apologize. But when I sell a call, number one, it has to represent a third to a half of the risk of the position. That's the rule. I do want it to be at or above the put strike price. Does it have to be above the cost basis? No. If those other rules are met that are discussed in the blueprint for doing income method number one, and if you're comfortable with the profit and loss chart. Now, I agree. This one might have been a tough decision for me. Although it is a wide break even, it does lower my risk and still gives you a potential of 3.9% return. I have to be comfortable with saying if the stock's in this price range, am I okay with that gain for my order goals? Or is it better to wait and look for that 31 call to get a better premium? Now, this is a pretty decent structure if you thought the stock was just going to be within 1 point of the 30 strike, not too much above, not too much below. But on the same day, if you had sold the March 31 because you felt that the stock had to be above, I'm sorry, the call that you're selling had to be above the cost basis, you get a better upside risk reward tolerance, but you don't do much to the risk itself. You didn't follow that rule. So I want to get more bang for the buck. And as it turns out, if we had waited, I could sell the 31 call today, it looked like, for, was it 60 cents? And that's a profit and loss chart I really love. Okay, limited risk, still potential 7% upside from about 38 days from when I opened the position. That's good because I waited, okay, rather than forcing it into the position. You want to pay attention to your cost basis, but the real key is that if you do sell a call right at the put strike price, even though it's not above your total cost basis, make sure you're comfortable with the graph going forward. If you're not comfortable with it, if it's something that looks like too tight of a position, then I wouldn't do it. What do I mean by too tight of a position? Let's just go to a married put screen real quick, and I'll show you. Here's a good one. That was pretty good. I want to take lows. Let's say I opened lows today at 97.17, bought the January 2018 100 put for 11.10, and I decided to force it him out. Let's go 28 days out in time and sell the 100 call. Pretty decent premium. It's going to be about $3 at midpoint. It's within my third, so that's pretty good. Not quite a half, but it's within the third. Okay, so this one is good. The break-evens, the upper and lower break-even before you start have to really consider adjusting the position because you're losing are still almost 20 points above where you are right now, or 12 points below, 8 points below and 20 points above. So this is pretty good. But what if we don't get that premium? What if we go too shallow, too close? Okay, for the shorter term time frame, these bid asks are all over the places. Lows is either something volatile is going on or they have earnings coming up. So this is what I kind of mean by too close, but not quite. You know, so if I sold, let me just take this down by half. I'm sorry. Let's say that volatility was lower and I only sold this for 89 cents. That's what I mean by too tight. A break even of 107 to 94.90 with the stock at 97. 3 points down, about 10 points up. That's a little bit better, but only a 2.5% gain at the best case scenario. Okay, so this is one where selling at the strike price because the premium might be too low is not something you'd want to do necessarily, because maybe wait for it to move up a little bit more, get a better premium for the 100, or maybe see if there's a 101 or a 105 that matches your convenience. Okay. Yeah, Sam mentioned something I don't do, and I appreciate that, Sam, but you know, another thing that he mentions, he kind of does something I don't do, and he says if the stock moves up in price here, like so Lowe's goes up to 100, he's saying, well, what you could do now is also sell a put closer in or further out, and he's right. You know, if I want to sell the 95 put, so now there's something that comes different here. This isn't part of, this creates a spread. It sort of creates a diagonal spread. If I put in that I'm selling it correctly, not buying it, there we go. Okay, but the problem here that I have with this kind of idea, even doing a bull put credit spread, is that if the market does turn more, you've added to the risk, because the long put short creates sort of a calendar put spread, but it can only cover, this long put can only cover the short put obligation or the shares of stock. So if it does fall back, you take the extra risk, and this is what we're trying to avoid here. I don't like to see that. Okay, so and if I did added a lower strike put to create a bull put spread, say a 90, now sure, that would give me a little bit of credit to help hedge it, but I'd also increase my risk by 5 points if the stock dropped below 90 from the original risk that I had in the position. That's why I don't do a naked put in this combination, even if I'm confident the stock's going to go up, or a bull put spread, unless it's part of one of the other structures, because we do that with income method number 11 and 8 as well. Okay, Mark, I don't know about that. It's a fair comment. Mark says, it just seems natural to me that in this correction where things have dropped, you'd want to roll all the puts in closer and lower if you believe this is a bullish condition. Well, I said it was potentially a light bullish condition and that I'm waiting for further confirmation. What I mean by that is that with markets being down, we could take a look at AMAT again. Let's go back here. Here we go. Yeah, let's go back to this AMAT one that's out to April. Okay, 9.1% at risk. You say, okay, well, I could shake this out now. Remember, I paid $7.35 for that put. I can sell it now for $8.10, $8.35. Not the best one. That other one we had a $16 gain was pretty good. Okay, so I don't lower my cost basis that much. All right, by closing it now. And I can buy it cheaper. He's right. Now, I could go cheaper, and I can buy a March 2nd now, lower strike put at 49. Still have protection in place, but I've lowered my protection 6 points. So now my risk is 11.6, and my break even is until 55.46. That's still kind of steep for 21 days. Now, I'll do this potentially if I've got a January put or something that's very far in time. That's what happened with SNE, by the way, Mark. That Sony position, I originally bought the stock at 50.50, and I want to say I bought the January 2018 55 put. And the stock sort of pulled back, and right before earnings, what I did is I sold that January 55 and bought 2 July 50s. But that's to play the earnings if it swang one direction and the other. Now, originally it swang up, and the position didn't look as good as I wanted it to, and I could have rolled the put up, sold both of the 50 puts, and bought a 52.5, and been at about the same risk. But I waited to see what would happen, and then a few days later, that's when the volatility kicked in. So now with SNE down to that range, $46, $47, holding the 250 puts on the position, I'm actually at a profit, even though I had originally paid about $56.50 into the whole trade. And the stock's only trading at 48 now. Is it a natural idea? I don't know, because it also depends on when you think the stock is going to come back up. See, if I roll to this March, but the gain to move back up takes longer, then I just took on more risk. I'm sorry, Ben had asked something a while ago. He says, NVIDIA at 288. Yeah, that was apparently the cost basis after adjustments and other positions that Indrajit was talking about on that position. So his cost basis from whenever he got in, whatever adjustments he's made going forward, was 288, and we were looking at management ideas on NVIDIA with his cost basis of $288 per share. Okay, it might have just been a straight buy. He might have been able to do covered calls against it. He might have bought options against it and had to roll them. But yeah, he's telling me for whatever reason his cost basis on that position is 288 at one point or another. Maybe he had sold calls here, and then he had to pay $10 to roll to the next, and $10 to roll to the next, and $10 to roll to the next. So adding everything up, with everything in place, he's got a cost basis of 288. Okay, Ben. So I didn't look it up, but I'm just saying that he had given me the idea there. Excuse me. That was his cost basis, and that's what he needed to repair. So how he got to that cost basis, I'm not concerned with. I'm concerned of where we go from here and how we can help him fix it. All right. Oh, no. Okay, something I should have gone through that a little bit more, Hemet, and I apologize. Let's clear this out. Is this right? Yeah. Okay. See, even Hemet, taking our example of the SH married put, if I bought 100 shares at 28.32 then, and when I sold the August 30 put, bought the August 30 put for 225. See, at the time, I closed out the chain again. I apologize. But at the time, even if I had sold the 30 call when I opened this position, even if I had sold the March 30 call here for about 35 cents, you say, well, wait, your total cost basis is 30.22. If you get assigned at March, you're at a loss. This was your idea. So I could get called out of the stock at 30 on March expiration, and I still have a cost basis of 30.22, so I'm at a loss. Your put does not go to zero. And you bought an August put, and only 35 days have passed. Yes, the stock has moved up, so the put has declined. But if the stock's trading right at $30 on March expiration, even if I'd sold the 30 for only 35 cents and still have a cost basis of 30.22, Hema, so I get assigned at 30. Let's say I don't do anything. I let the stock get assigned at 30. Okay. If the stock's trading right at 30, my put's still worth $1.39 worth of time premium. Okay. So, well, I lose on the put, but we get assigned at 30, and I sell to close my put for 139, so I have a profit of 117 off of 30.22, right? So, you know, we take the profit in, sell to close this at 139. We know we gave up 22 cents. Well, there's kind of the profit there of 117. What if it's at 35? Well, you would have seen that by this chart. If my expectation was at 35, I'm not trading this. But what if the stock suddenly gapped up to $35 on March expiration? Well, yeah, I'm going to lose $4. Why? Because I get assigned at 30 and my put's still worth 18 cents. So I miss out there. But see, the reason why you're losing money here is because the put's declining, that's right, but you're not getting any positive delta because you capped the gain with the short call. Okay, so you don't get any more positive delta. Your put's declining, you get 30 back, whatever the put value is. But even if it's below the cost basis, even if the strike of the call is below the cost basis, if the expected value of the put is still reasonable, so let's go to $31. And what would happen then? Well, we'd maybe forced to buy to close the call at $1. But let's say we got assigned at 31. My August put is still worth 98 cents. So we get assigned at 30. We take a 22-cent loss from our cost basis, sell to close the put for 98. It's a profit of 76 on the position, about 2%. Not bad, but that's what would happen there. So, but if it keeps going up now, you're not getting anything back from the stock itself. You're just losing it and losing and losing. Okay. All right. Oh, you bought this at 10 today. Okay. All right. Yeah, Ben asked again, you know, how did they get to that price? I don't know. Okay. I just don't know as well. Okay. Mark says, question, is your job as fun as it looks? At times, but I gotta be honest, I have so many ideas and concepts and historical testing and historical charts that I want to do and things to look up. I'm gonna be honest with you, Mark, it took me almost 3 hours today just to put together those 15 slides we looked at where I was grabbing the prices and grabbing the chart and showing what had happened. Because in addition to that, I got 15 phone calls and I got 8 phone calls and had to answer 15 emails. Plus I'm working on redoing 3 other projects for radioactive trading to update all the Mastery Series videos. I've got that long call blog, video blog I want to put together for one customer. We're talking about the VIX there. We're still going to finish up the stock or portfolio insurance. So is it fun? Absolutely, it's fun. But at the same time, I'm always finding myself behind because, as you know, as the market changes, so does our trading, but so does then the education I want to get out to people to talk about what's going on in the market, what they might want to consider with their trading. And then 2 days later, the market's different and what I was planning doesn't really apply, but I still want to get it out there. Okay. Sierra says, sorry I was late. I was confused by the time zone. Is a video going to be available? Absolutely. I will. This is being recorded, and we will post it as we always do to the webinars page. Their home free webinars will also post it on YouTube, but the public page there is powerop.com/webinars.asp, and the requested topics is where we put our Friday presentations. I'll send everyone an email when this is posted as well. Okay. Okay, so sorry about that. This is from Mark J. He was late arriving at 5:30. He says, can you comment on the current environment where implied volatility has both expanded and decreased over the course of each day for several days? Gyration in the option prices without price change on the underlying. Yeah. It makes it harder to tell, absolutely, or even understand if you're getting into a price that is sustainable. Do vertical spreads tend to remove this volatility effect? Yeah, okay, so the problem is that what Mark is saying is that, and we saw that earlier with one of the kind of examples we looked at, in the sense that during the trading day, you might not see a stock move, but you'll see the VIX move. Okay, the volatility index here, you know, down 440, things were up. But the VIX was ever changing today. I mean, I think the high was, 33.46. Today's high was 41, and it dropped to 27. That is huge. That is a huge swing for the volatility index, and it's going to affect the prices. Does a credit spread or debit spread sort of mute some of that volatility? Absolutely, it does. In the sense that if you're not watching it on a day-by-day basis. What do I mean by that? We saw earlier how back in the end of January, January 29th, February 2nd, before this volatility spike hit, we saw some options that were normal prices. We saw some married puts that were normal prices on different positions. SH we showed and a couple of others before that volatility kick had come in. Now, for a married put, it can be interesting because as the market falls, your call can still gain, your put can still gain in value. And of course it's going to, but it could gain higher. In some instances this week, I've seen my put gain more than the stock has dropped, which is very nice, right? Because the implied volatility spikes and I'm getting the intrinsic gain on my put to hedge my stocks. It's rare that it happens, but when the volatility spiked on the 5th and the 6th, a couple times my AMAT married put, I saw a bigger gain in my put than I saw a decline on the stock. And that's not supposed to happen when you have a delta of 0.5 or 0.4 or 0.6. But when the implied volatility spikes, you absolutely do see that from time to time. That's a benefit. On your spread, it's a benefit because it kind of mutes it because you still know what the maximum risk is. You can't lose more than the difference in strike prices at expiration, even if the stock is trading below both strikes in a bull put or above both strikes in a bear call. But day to day, you're going to see wild swings. In this type of environment, Mark, you're going to see wild swings where I could have opened a position, a credit spread on February 2nd for 20-cent net credit on a 2.5 or 2-point spread, about a 10, 11% return, okay? Midday on the 5th or the 6th, I might have seen a liquidation price of that potentially at natural. You know, if I bought to close the one option at the natural ask and sold to close the other at a natural bid, it might have been a $3 liquidation value. But I have a 2-point spread. How am I losing more than 2 points? Well, number one, I would never close it anywhere other than at midpoint or close to it. Number two, it's really hard to scramble to try to close when the volatility is spiking like that. Okay? So does it mute it? Yes, because in the credit spreads, you always know there's a maximum risk in the worst case scenario at expiration. The risk is when the market is popping around. I did see an article today, too, in addition to the one we kind of showed earlier, some of the concepts there. I saw an article earlier of someone mentioning, is this, does this market look like the 2000s or 2007? And I thought about it for a moment. I thought, wow, that's a great point. And the reason why is because I had many customers who were still profitable going into the turn of 2007. I had one customer who made, I think he said $30,000 on credit spreads in, I think it was September and October of 2007, and then he gave it all back in November, okay, within the first 3 weeks. And the reason why is because he had put stops on his spreads. And so they were getting triggered left and right. Why? Because during that time frame, in addition to the volatility moving, I would come in the morning, answer a couple emails, and then as soon as the market opened at 9:30, the Dow was down 600 points. Okay, and then it stayed down. Then the next morning, it was up 500. Then the next day, it was down 400. Then the next day, it was down 200. Then the next day, it was up 300. Go over the weekend. It's up 50. Then the next day, it was down 400. Then it was up 300. Then it was up 50. Then it was down 200. And so every day there's just a wild swing where it gapped and then it stayed. It gapped and stayed. It was killing vertical spread traders. People buying straddles and strangles were making a killing every day, left and right. Those who were selling vertical spreads or selling short straddles or strangles were getting murdered every day in their portfolios. It was very interesting. So it's going to be interesting for me to see. We've seen the down days. Now with the volatility staying at 29 is pretty decent, but if it falls down on Monday and Tuesday, I think it'll be okay. But if it kind of creeps back up, we might be in that field where we're starting to see 100-point jumps every morning, one direction or the other, with no, trying to figure it out, okay? No, Sam, I did not do the straddle on Twitter. I did not do an earnings straddle on Twitter. And Mark, I see your comment. I'm going to do my best. I believe I can. I'm going to try to figure that out before I post the recording as well, Mark. So I'll try to take care of that. I have 2 ways I can do it as well. Okay? All right. All right. Oh. All right. So for Ben and for Indrajit, apologies all around. Indrajit just commented. He said, whoops, he even typed it to me this way. He said his cost was 228, not 288 on NVIDIA. Well, that's a horse of a different color, as they say. So let's go in here to NVIDIA now. Let's see if the programmer's fixed what we're looking at here. There you go. This is probably a little bit better for seeing some of the insurance plays intrajit for the married put with 228 in NVIDIA, not 288. You don't need to use the stock repair because the stock's already at a profit. So Ben, I'm glad you pointed that out because I had no knowledge. When someone brings it to me, I don't look at the full chart. I just look at where the stock is now. NVIDIA is not one that I track on a regular basis. I've had to have conversations on. So Ben, I thank you for mentioning that. And yeah, so this is what we'd want to look at here, intrajit, the 228. And you can choose the expiration that matches your cycle. You're not quite enough unrealized gain yet to be bulletproof there. Oh, sorry, I should have gone to June maybe, because you only have an unrealized 1.8% gain, but that'll help hedge some of the risks here. And at 232, yeah, I'm probably focusing on the 240 put, even though it's a 7% risk. I might even go out further out in time. That's a pretty good risk there. The 235 at 8 is not bad. You could start managing that quickly as well, or more effectively. So that's something to consider. We can talk about that later on because we're already 10 minutes after 6 here. All right. Going back to Hamant, he says, for radioactive trades, it seems to me that you want to avoid stocks that stagnate. Yeah, that's the best thing that you can do. And I got to admit, a couple of mine were stagnating and then they took wild swings. He says, do you pick stocks that move quite a bit, like Tesla, Apple, Netflix? To tell you the truth, Apple and Netflix really aren't that volatile. You say, oh, well, it could move 10 points. Well, sure, Apple might move 10 points or 8 points in a day, and it's a strong stock. But if it moves 8 or 9 points a day, it's on a $150 stock. Okay? So, in my mind, let's say it this way, if the stock moves up 10 points, you say, oh, Apple can move 10 points. It could be trading at 166. Okay, well, that to me is the same as seeing a $15.60 stock go up to $16.66. Well, is it the same? No, it's not. Apple's probably much better and a better quality position than this. Do I trade these? No, Hamant. Do you know why? It's just talked about in the blueprint personally for me. It's talked about on the Fusion portfolio as well. Yes, I want a stock that moves. In fact, in the default search and the criteria that we use, we're always looking for stocks that have at least a volatility of 25% or higher. We want to see some movement. Okay? But my portfolio size, you got a hint of that from already earlier on in the presentation when I talked about putting up $700 and making sure it was no more than 2% of my portfolio for the VIX hedge. Right away, you kind of know how much I'm trading with or how much I'm allocating to options. Well, with that type of allocation, it dictates that I should not be opening married puts on stocks that are above $75 to $80 per share. And that's perfectly fine. See, I don't want to have just 2 positions open where the stock's trading at $150 or $140. Earlier, we showed the portfolio with the 3 bull put spreads and the calendar spread on Amazon. Why am I trading a calendar spread on Amazon? Because I can't afford to do a married put on it. I can't buy the stock at $13.40 and buy a $13.60 put for $95. I just can't do that. Okay, so I did a call at $88, which is like buying an $88 stock, and then I sold a call against it for $7.50. Okay, so rather than the married put on the higher price stocks, I might do a diagonal. All right, but they're good stocks to use. We want movement. We don't want stagnating. Even if it moves down, I showed how you could potentially adjust the put in 2 different ways to kind of maybe get a lower loss and lower the cost basis, okay? And that would, you could lower the risk there and do it also. So that's kind of what I'm looking at with that as well. So these are good stocks to use. It just depends on your personal portfolio size and cost basis. All right, a couple more here. Mark asked, oh, I'm sorry. Now, Sam does Apple and Netflix, and he said that because they move big on earnings and news catalysts. The FANG stocks are good ones, and I think, Sam, you've played some of those recently too, but they do have positions where they can be flat for months after the catalyst, and that's true. So in that case, these are good positions to use, but the volatility is not overwhelming compared to other stocks. You're right at 21 for the 100-day volatility and 23% for the 50-day. That's not really high. 40's high, 50's high, and of course the 20-day's higher because of the recent activity. But this isn't extremely volatile. It moves, and you might see an 8 or 9 point movement, But again, it's because it's a $156 stock. All right, Mark, again, came back. Mark J, I think. Along the line of using the radioactive trading technique in high volatility stocks then, can the cost of the protection make this angle not workable? It is more difficult. I don't trade it with biotech stocks because buying the put that I'd want to, that's only 2 strikes in the money mark on a volatile biotech stock and 150 days out in time, 5 months out in time, is going to put me at a 20 or 30% risk. I don't want that. In order to get the 7% risk, I have to go 40 to 50% in the money on the biotech stock. I don't want that either. All right, so I'm going to go 3 little bears. I don't want GE or Oracle that doesn't, but I don't want GE right now anyway until I can get a better beat on it. But I have traded Johnson & Johnson and Kraft in the past and had double-digit profits as a married put over 11-month periods because of the growth in the stock and because of the way I traded it with the radioactive techniques and the adjustments I made. But in general, I don't look for something that has that low of a volatility. An Oracle or a GE, unless you think the stock's going to have good growth, a good couple of quarters while you're in the position, then it's a good play. All right, but on the other side, no, I don't do it that way. And I don't do it the way, now one of the advantages is, of course, if I did GE, I could buy the at the money put instead of going in the money and still only have a 3 or 4% risk. Okay, but I still need movement to be able to do good adjustments and make some profit. So the riskier ones, the biotech ones, those with higher volatility, you've got to go deeper in the money to get the single-digit risk you want. And I do have radioactive traders. I do have Blueprint owners and who are PowerOptions subscribers who only traded on the biotech. They're willing to take a 40% loss on the position going 2 or 3 strikes out of the money and the chance that the stock may go up 80, or if it drops 60, they only lose 40. Not my game. I'm going to keep my risks to under 10% on those positions and look for some good volatility to still make a good profit. Naturally, of course, we've had that over the last 2 years. Be interesting to see how we turn out this year. Ben asks, have you simulated a case where you buy a 1-year long put and day trade on that stock? No, that's not my approach, or swing trade. Now, I'd rather adjust the put myself and hold the stock, and then if I decide to close part of the stock or add more to it and reevaluate the position in a good growth section, I'll do that. But in general, I don't swing in and out of the stock and just leave the put. I want to think. AMAT, I could say it both ways. AMAT's a position. Let me just pull up the chart on AMAT. It's a married put I'm in. I have to do something with it. I wanted to do something with it this week, and I didn't. And then I decided, just like we all did, as we talked about before, I decided just to let it take a breather and let it take a break. But AMAT is a stock. Let's go to a 6-month chart here. This 3 months is pretty good. This is a stock where I could have profited. I feel a little bit ashamed that I didn't, but I could have profited wildly on this position instead of just kind of waiting back and seeing what earnings were. It peaked up here at about 61. And you could say, okay, if I had sold the stock here, and then when the stock fell here, now I bought the stock, and when it came back up, I rolled the put and then sold the stock, and then bought the stock back here, and then when it came up here, I rolled the put again, and then sell the stock. It'd almost be the same as if when it fell down here, I rolled down the put, then it came up, I rolled back up the put, then it came down, I rolled down the put, then I rolled back up, rolled down, rolled up, and then here, maybe so, if you could pick it, when it's across here, sold the stock, and then left the put open. I try not to do that. And again, Ben, one of the reasons why is that you can tell already from what I answered to Mark, I don't know if you were here then, but that's not my style. Meaning also I don't have the time to do that. I know a lot more. Sam is much more of an active trader than I am, and he even does stuff like this from time to time, moving in and out of stocks and calls and puts and maybe buying stock with a put on it. It's not really radioactive. It's Sam's method, but it's still protected, and he practices proper position sizing. But again, I had mentioned I had taken a few phone calls today and answered several emails, and I was working on other projects. I don't want to watch my screen all day or even try to make as many as 10 or 15 adjustments per week. And maybe I'm missing out on profits, but my goal is longer-term growth with not having to feel the need of watching my positions every half hour to 45 minutes during the trading day and then trying to react with the market. I'm going to let things play out a little bit, knowing I've got the protection in place, and then move on, okay? Yeah, Sam's kind of, he's not countering me, but he mentions that, the FANG stocks are all momentum stocks and they can move big time. Absolutely. The first day the Dow dropped, Amazon was up $40. Yep, that was around the time I was having fun with that positions. Okay. And Mark, to answer your question, you can probably profit better. I can see it this way. You can probably profit better if you are better at timing than I am. What you've essentially said is, do you ever put in a buy stop to leg into the married put? I don't personally, okay? If I see a position I like and I go through my research of looking at the stock chart, company information, news, and profile, and at that time I feel like it's a good married put to enter, I'm not going to try to leg into it by saying, okay, we're on an up day today, so let me buy the put, and if we pull back tomorrow, I'm going to buy the stock. Well, then if the stock keeps going up and up and up, well, sure. And you're right. You say, well, why don't you maybe buy the put in the morning and then set a buy trigger that don't let this go above $30.50. Okay, but why not just get in now at $30.46 instead of trying to wait for it to pull back to, let's say, $30.10 or $30.15 and then buy it then? I don't do that. I'm lazy. Okay, I'm lazy in the sense that I try to keep it simple. If I decide I'm going to open a trade today for the Fusion subscribers, which would be my personal portfolio, I'm going to go in, I'm going to look at this list. You heard me already talk about how to analyze SkyWest before. I was considering that one. Red Hat I like, but I think that's going to be a calendar for me soon. I had good luck with that bull put credit spread. Lowe's I looked at, but I just don't think there's as much. It matches the criteria. I just don't know if there's enough volatility in it right now to make me comfortable. But it's usually a good time to look at those. And so anyway, I would enter it now. I would look at this, analyze the position, the stock, and the option, go to my broker, put in midpoint there, try to get maybe a little bit better than that risk if possible at 5.8%, maybe try to get 5.5 or so, and then I'm in. And then if the stock falls, well, maybe I can do an income method in the next 10, 15 days. The stock moves up, maybe I'll do an income method then rather than trying to get in a day or two later at a different price. Personal preference, Mark, not the approach I want to go for. I've heard Ernie do this, and to answer your question, yeah, usually when I go to my broker, I try to get filled on the put first to make sure I have that in place, and if I get a cheaper price in the stock, that's just bonus, but normally I'm putting them in together at the same time. Ernie's done that in the past where he's tried to get filled on the put first, made sure he got filled on the put, then went in and bought the stock, and the stock had pulled back, so he got a better price on the stock. But again, I don't do that on a regular basis. All right. I think I answered all the questions that came in, including the little discussion we wanted to have for everyone to remind everyone to, of course, not panic. Take things simple. Let's all relax here. Take a breather. We'll kind of be fine. Some of us may have taken some losses. There are things that we can do going forward. There are things that we can do. We talked about the blueprint. We talked about the radioactive trading techniques, getting more familiar with those. Again, check out the blog, blog.powerop.com. You can look up the couple of webinars there, or a couple of discussions there. We have stock and portfolio insurance on the webinars page. We also have other information for you there, managing spread positions and manage a broken stock position. We talked about considering inverse ETFs as well for different structures. All right. And as I mentioned, everyone chimed in and everyone got to chime in mostly. Thank you all for having a good weekend. But, these are my thoughts on the questions, the market conditions, educational purposes for increasing investment performance and knowledge. Any of the stocks or options discussed today should not be taken as direct trading suggestions. Remember, what is key? Minimizing risk, proper position sizing, going with the flow of the market. Don't panic. We've got the tools to help you. We've got the education to help you as well. And keep in mind, too, for those of you that haven't, remember, simply go to powerop.com, put in your name and email address, and you'll get access to a 14-day free trial. After that, of course, the subscriptions start at $40 per month for the end of day, with only $60 per month for the delayed service and beyond. Okay. Mentioned, check out the blog, blog.powerop.com. You may also want to check out the webinars page. We'll post this sometime this weekend and let you know when it's available. Those of you that are seriously considering the limiting risk, the married put techniques we showed today, always in control where you're not losing more than 4, 5, or 6% of what you invested, go to radioactivetrading.com and at the least download the free white paper called The Sketch. Also, if you have questions about the blueprint and the 12 different income methods and how it can benefit you, which we already showed today, send me an email to support@radioactivetrading.com. Well, Indrajit, thank you for joining us. Serious there. Okay, and Mark says, good. Just letting you know, I expect to upgrade my membership to the non-delayed status and the back test available there, in part thanks to your weekly seminars. Mark, that's fantastic. I'm glad you're getting useful education there. Remember, as always, give me a call or send me an email anytime you have any questions. You trial members and subscribers, you can always schedule a coaching session as well. All right. Everyone take care. Thank you for joining me. Thank you for your great questions. Let's take a breather here. Let's relax. Let's get ready to see what Monday has in store for us. Have a fantastic weekend. We'll see you soon. Good night.